understanding for price action traders like you and I, understanding when is the right time, what actually confirms your trade entry, your trade entries when you're opening positions on the forex markets. What do you look for? And this further guides us to determine the levels whereby we get to set stop loss and take profit, which is of utmost importance to a trader. Money management goes hand in hand with trade confirmation. And if you take forex trading as serious as we do at 4th Street Consultants, if you take forex trading and you approach the markets as a business, not as a hobby or just something to try and gamble overnight, and you're looking forward to make consistent money from the forex markets, then this is of utmost importance. We covered this in our price action course that we offer at our company at 4th Street Consultants, and we're very glad to have this opportunity to just take you through, share with you our experiences and some of the virtues that have seen us even live long in the markets to be consistent professional forex traders. Without wasting further time, I think we'll move right into the meat of the topic. The topic for the day, of course, is confirmation of trade entries. Then we have the topic with us, and I'm going to approach this topic the same way I have been approaching the other webinars, whereby we will cover the theory that is presented to us, that will show us on our screens from our slideshow presentation. And then after that, we're going to move over to the live markets using the EGM platform MT4 account. And then we're going to take a couple of chart patterns, support and resistance, and these are the elements and content that we've prepared for you to just bring that element of practicality of what we're discussing in the theory into the practical world of the MT4 Forex charts. And we're going to use the same formula. And then at some point, of course, we will take your questions and address them and get to discuss and exchange ideas. The first, of course, subtopic that we're going to cover under trade confirmation is, the three, points that you need to understand before you enter any trade. We call them, these are the basic questions like you ask yourself, and these are things that we teach our traders every day. The first question you would ask yourself before risking your money into the market or before opening any position after analyzing for price action is you need to understand and tell what is the main trend. For those who missed the last webinar, it's available on our YouTube channel at 4th Street YouTube channel, and it's available on EGM YouTube channel, whereby we discussed at length how to identify trends. And then the point that you need to understand anytime before you take a position is you need to determine what is the main trend. And then the second one is, can I identify chart patterns in the trend? Are there any logical, price action chart patterns that informs us or helps us to set ourselves at an advantage in the forex markets? So this is one of the questions that you have to really understand. And if you can't find a viable, elaborate price action pattern, then it's not worth taking a trade. It's not worth risking your hard earned money in the charts. And wait, just be patient, wait for an opportunity to spot patterns that align with the main trend of the market. The old saying where they say in the Wall Street that we are friends to the trend until it changes. And this is the whole point. And the third point would be, of course, are we in the action stage or the reaction stage? Will you trade the trend or you wait for, a pullback of sort in order to join the main trend? That is in case you missed the first trend. Moving forward, if after you can analyze the charts and tell the main trend, you need, of course, to you know how to tell the main trend, you know, to tell the strength of a trend. You remember in the last webinar when we were covering the topic of trend, we discussed the various ways in which we as price action traders are used to tell the strength of a trend. One being the angle of the gradient, and of course, how strong are the candlesticks, the bodies of the candlesticks. And these we covered in our last webinar for those who followed with us. And for those who missed it, it's available on our YouTube channel as well as EGM Securities YouTube channel. You can always feel free to go back at it and fetch some knowledge from there. Then, of course, after telling the strength of a trend, then you can move ahead to analyze chart patterns. Do we have elaborate or clear chart patterns and price action signals that you know, are alongside the main trend? Because this is how you get to be at an advantage in the forex market and to make money, because you do not want to trade against the trend. And therefore, our role as price action traders is, once we identify the main trend, then of course the next step is always to analyze the chart patterns that are available in the market using the top-down approach, which is another topic that we discussed in our previous webinars, and we cover it extensively in our price action course at FourthStreet Consultants. Then, of course, the next point is chart patterns always shows the balance of the market forces of supply and demand. Of course, if you're able or you have the skill to analyze chart patterns, you can interpret what they mean or imply in the markets. Then, of course, you understand where a certain currency pair that you're trading or analyzing stands as far as supply and demand is concerned. Of course, if the base currency has more, you know, supply or demand, then we have a bullish trend, and the vice versa. I don't know. I think I'll call up George right now to add, you know, a point or two regarding chart patterns, identifying the main trend, and how to identify chart patterns that show the equilibrium forces of demand and supply before even we move further to the next points that we have. And then later on, we're going to be shifting to the MT4, whereby we'll be showing you live examples of how to tell or to identify confirmation signals and how to approach the forex markets before you just pull the trigger or you know, open a trade position in the forex markets. And therefore, George, at this point, kindly come in and talk to our audience, share one or two regarding what we've covered so far. Then we can take it up and move on.
Yeah, thank you so much, Mr. Joshua. Yes, chart patterns. Now, these patterns show you how the forces of demand and supply relate to each other. And I can't hear myself. And when there is a balance of the price, where the buyers are in agreement with the sellers, we normally see the prices ranging or consolidating. Okay, we have areas where the buyers are in agreement with the sellers, and normally this happens most of the time because trends do not actually occur a lot, and when they do, it's usually due to the imbalance of the forces of demand and supply. And basically, chart patterns, they give you the insight of how is the demand and supply forces playing out. We have patterns like wedges. Wedges show you like there's a certain imbalance, or if the buyers were in control and then they start forming the wedge pattern, the buyers are actually getting exhausted, and we see now the sellers step in.
Thank you, George. Thank you, George, for that polish up. And George has touched a bit on wages, touched a bit on a few other chart patterns that we will be getting into their analysis in a few minutes after we're done with the discussion of the pointers of the theory, and of course, we'll be getting to show you live, as I promised, on the live markets, how we approach, the markets on the MT4 to analyze for trade entry confirmations, and how you're supposed to go about trade confirmations before you pull the trigger or you open your trade. The next pointer that we're going to discuss under today's webinar is the candlestick formations. The candlestick formations for us, price action traders, for me and you, is that these are the basic representation of the behavior of the market. When we talk about supply and demand, what informs us of supply and demand and who is taking control of the market, whether it's the bulls or the bears? And therefore, candlestick formations are the vital, actually, not a vital, this is the main tools that we use. While other people base their trading decisions on lagging indicators, our charts are usually pure and clean. And all we're looking for is candlestick formations and patterns that are in line with the main trend that we discussed earlier as I was starting on this topic. And once you've answered the previous questions of the trend, then you can go ahead to look for candlestick formations or candlestick patterns that inform us of our entry points, because they tell us the status of the market. Candlestick formations are our leeway to knowing who is taking control of the market. Is it the buyers about to push the market up, or is it the sellers or the bears who are about to push the market down? Or are we about to experience some consolidation? And we get to decipher all these based on the candlestick formations that happen on the forex charts. Of course, we have different types of candlesticks and how we interpret them and the information they tell us about the markets. And we have, indecisive candlesticks. These are candlesticks that simply inform us that it's not time to pull the trigger. It's not time to open a trade. Probably the market is in a stagnant or in a ranging mode, and it's not clear, for us to open a position or to take sides, whether it's the bulls or the bears taking control of the market. And this we get from analyzing the shapes of different candlesticks, whether it's the tail, whether it's the body, just the different candlestick formations that happen in our forex charts. Of course, when the investor sentiment has changed, or supply or demand of a certain currency pair or commodity that you're trading is about to change, then we get to experience reversal candlesticks. If we analyze the forex charts like we're going to be doing in a few minutes, and we find that there is reversal candlesticks which inform us that the investor sentiment is about to change, or whether the bulls have exhausted their buy power and the bears have exhausted their selling power, then we know as price action traders, now it's time to go long. Now it's time to go short. If it's an indecisive candlestick, then we know now it's time to wait. As they say, in forex, unlike other business models, we always say that less is more. This is a point that you get to learn with experience. And during our years of trading, we had to do tons of mistakes, make losses in order to know this and how the dynamics of the markets and the sentiment of the markets. And this is a fact that less is more in trading. By that, I mean, and I always say this every time I get a chance to, talk to traders or any audience as far as forex trading is concerned. And I believe George will agree this with me, that usually less is more. And therefore, as forex traders, we're not looking forward to initiating or opening multiple trades in a week or in a month in order to be profitable. Unlike the dynamics of other businesses, we just actually, one of the most famous, sayings of one of the bigwigs of stock and forex trading, Warren Buffett, is that 90% of the time, I'm not trading the markets. I'm just waiting, and all they have to do, or all we have to do, is wait until there is free money lying somewhere, and then ours is to go and collect it. But if you're not patient, if you're not mastered, you don't have a trading plan, if you don't master the right candlestick formations, and tell the trend of the market when to wait and when to trade, and these are all skills you can only get with a reputable forex education, then you are as good as gambling your life into the markets, or trading the markets. And we're here to just tell you the truth, how the market goes. You need to learn how to read the market, be patient, do less trading, do more watching. Just wait until you can spot clear price action candlestick formations, and all you have to do is follow your money management plan that you of course in place, you have set in place, and all you have to do is follow your money management plan, and then analyze for your levels of take profit and stop loss, and then go for the trigger with the confirmation of the candlestick patterns. And that is a topic that we're covering, and we're going to get even deeper into this when we visit the charts on the MT4 on the EGM Securities platform. And of course, the resumption of the trend, that is the continuation. Candlestick formations actually also tell us whether a trend, whether it's a bullish trend, whether the buyers have still have the muscles to push the trend further, which means we can trail our stop loss and maximize on our gains. And of course, it's the same candlestick formations that inform us when a trend is about to change. And we discussed this on our last webinar that we did last Tuesday, when we're covering about trends and how to tell when a trend is about to end and all these elements. And therefore, these candlestick formations inform us when a trend is ending. These are our triggers, not just triggers to enter the market, but triggers as well to exit the market. When we've been riding with the trend and we need to analyze the candlestick formation so that they inform us when to actually get out, so that the profits that we've already made are not taken back by the markets or lost into the markets as the sentiment changes. And this is the essence of confirmation of trade entries. And therefore, the next topic, subtopic that we're going to cover before we move on to the MT4 platform to cover on our live markets, the different types of trade confirmation based on different chart patterns, then is there are various techniques that we use to make trade entries. Confirmation usually occurs after auspicious candlestick formation and a strong follow-up. It's more of the same what I've been discussing in the previous topic. We always wait for the closes below or above a level, that is a support level or a resistance level, like I'm going to explain in a few minutes on the charts. And therefore, our goal is to always keep it simple, be disciplined, wait for the chart pattern to complete until it gives you a confirmation. Then that's a go ahead to open a position. If there's no confirmation present on the market, then you are better off not risking your money in the markets. Just wait. It could take a few hours, it could take a day, it could take 4 days before you get a clear price action formation or confirmation to give you a go ahead to open a trade position. But what if I told you you only need just a couple of trades in a month to just crack it and make money in the forex markets? What if I told you actually 2 trades or 3 trades or a maximum of 4 trades in a month or 5 trades at the very most are more than enough in a month to make you money in the forex charts? Because it means if you're taking less trades, you're paying more attention to capture quality trades and the best of the trades. And this, when you talk about quality, is a trade that is alongside or is along the main trend of the market. When you talk about quality, we're talking about a trade that offers us a significant risk to reward ratio. In that, by that I mean the money that we're risking in a certain trade is of course way less than what we're targeting to make. By quality trade, we mean there is a clear confirmation that has closed above or below the support or resistance level, depending on which direction you're following the trend on. And these are important lessons that I can't overstate. The candlestick formations are covered in our price action trading course. Our course covers solid price action trading, formations and confirmations of entries. And our course is usually an online course, and we offer free consultation for traders who get or register with us. We have traders in-house who just polish our traders. They just visit us at our offices with their questions, and we get to mentor them for free for 6 months. And this is just a bit of what we cover in our price action course at FourthStreet Consultants. And therefore, at this point, I think I'm going to call George again to uh, just talk a bit, give a point or two regarding the confirmation of trade entries, about the candlestick formation. Why is it really important to wait for, this confirmation candlestick to close below or above a support level, or whether it's in a breakout, for a confirmation candlestick to form outside the breakout in order to open a trade position? Why is this really important? Why are we even having this topic in the first place? So let's get to hear this from George. Then from there, I'll take you straight to the MT4, whereby we're going to be discussing some of the chart patterns live with you on the charts as we draw them and show you some of these confirmations that we've been covering so far in our slideshow presentation. So George, take up.
Thank you so much, Mr. Joshua. Yes, confirmation of trade entries is something that takes beginners a lot of time to grasp because they are excited, since they can read certain candlesticks, they understand the candlesticks, but they usually have a problem with waiting, and that can be very costly. And most of the time, breakouts do not actually happen. You may see a breakout in a certain level, and then the prices close back within the channel or within the consolidation areas. And this traps traders into trades. What do we mean by trapping a trade? We were in a downtrend, and then we saw a certain bullish candle popping or a candle moving the prices up, and then you said, yeah, we are going up, but you did not wait for the close of the candlestick, and it was just a whipsaw, or it was news, or it was just a market spike, which actually happens a lot. But since you didn't wait for the close, you're trapped out in a trade. And that's why we always emphasize, please, please, please wait for the close of the candles. Wait for the close, because the close shows that actually the momentum is going to maintain. Okay. And candlesticks, you can trade entirely using candlesticks, but you do not advise that, because candlesticks provide a lot of trade setups, but if you do not combine with what you have told you from the trend to chart patterns, you're going to make very many trades that are so wrong. And that's why we always emphasize, follow the paradigms that you have told you. Can you identify the trend? Can you identify the chart patterns? Okay, there are people who are comfortable trading chart patterns. Please understand your personality. What works for you, what works for me may not work for you, but essentially, do you understand the process? I'm more comfortable trading consolidation patterns. Others are more comfortable trading trends, and they wait for breakouts. Okay, I wait for currencies to trend and be caught up in the equilibrium. That's what I'm comfortable with, and I wait for confirmation of the equilibrium or the imbalance. I always have to wait. Whatever your trading style, I always have to wait.
Wow, thank you, George. Thank you, George. You mentioned actually a very interesting point, and that I must add on to that. as you develop your trading plan, and this is a whole topic in itself. I just want to take a minute or two to, share this with our audience. How do you go about developing a trading plan? You know yourself, you know your level of patience. Can you be patient for 2 to 3 weeks for your trade to work out? When you're developing a trading plan, always make sure that the trading plan is in sync with your personality. Are you the kind of people who are looking for, some instant gratification? Can you be an investor? How much can you exercise patience? Of course, it goes without saying that you have to control your greed. You have to control your greed in Forex. Don't go out of your money management plan. For instance, if your risk plan, as we teach at FourthStreet Consultants, for traders to approach the market with a conservative risk exposure, if your exposure is, let's say it's 4% of your capital, then it means at any one point in the market you will not be risking more than 5%. That is, if that is your risk management plan. Whichever the number of trades that you have open, your total money that is exposed on the market, it won't be more than that is according to your money management plan. And therefore, these are all elements you need to factor in when you're developing a trading plan. A trading plan informs you, how to set your levels of stop loss, how much you're risking into the markets. A trading plan informs you which are the techniques or price action entry patterns that you'll be analyzing or looking for in the chart patterns. Your trading plan informs you on what time frames will you be analyzing the Forex market to look for these opportunities. Your trading plan informs you which are the pairs that you're going to be analyzing over and over, day after day, because you can't just jump from a pair to the next. So you need to have a series or a number of pairs that you always analyze day after day, and this way you get to develop and learn and master their movements. A trading plan informs you when or what confirmation signals do you wait for before you pull the trigger, which we're covering today in our topic of confirmation of trade entries. So those are just 5 elements, and it's not just all of them. And this is what constitutes a trading plan. If you go right into the markets and you're just about to open a position right now or any time in your life without having a proper documentation of a trading plan that includes mainly the points that I have highlighted, then you're not ready to trade. You're not ready to risk money in the Forex market. That's the fact about Forex charts. It's not that hard, yet it's not that easy. It all depends with you. And I think this is a philosophy of life. Like, life is not hard, it's not simple, it's your mindset, it's how you trigger or you plan for life. If you don't have a plan, if you don't have a trading plan, you don't know how much you're risking in the markets. You don't know why if like I approached you today after you taken a position and I asked you, why did you place that position? What's your risk to reward ratio on this trade? Did you have a confirmation before you entered this trade? Are you trading alongside the main trend? If you can't answer some of these simple questions, you can't don't waste your hand money. We went through these mistakes in our earlier years, and we're here so that we teach you and mentor you so that you don't have to go through the hooks that we had to go through. And these are the simple rules of Forex, and there is no other way out. Don't be cheated. Don't listen to, online YouTube videos of people telling you how much they're making overnight. It doesn't happen. If it was that simple, then everybody could have been a billionaire out of the Forex charts. And the fact of the matter out there is that 80% of traders lose money. So just take a minute to ask yourself, if 80% of traders out there in the world lose money, what do I need to do different to be in the 20% that make money consistently? So if you ask yourself that question, then you realize how important it is to understand the dynamics of Forex markets. what really works, what moves the market, understand the dynamics of supply and demand, understand why it is important to space your trades, to give them breathing space because of the market noises that happen every day that sweep the day traders and scalpers stop losses. Understand all these, understand that the higher time frame of the forex market is always superior, and it's a predominant time frame of the trend, and you want to open your positions that are aligned with the long-term trend of the market. I can talk and talk about this, but this is how serious we take forex trading. We approach forex trading as a business. This is what we live for, and this is what we train our students at 4th Street Consultants to approach it as a business and employ all the principles as far as successful forex trading is concerned. And therefore, as time is rushing pretty fast, I just want now to move straight to the MT4 charts. And this is just a free session of some of the pairs that we just will be looking at, screening through, in order to take you through some of the chart patterns that we have identified across the different currency pairs that is showing on our charts. And as you can see, we've analyzed different chart patterns on different pairs that I'm going to be taking you through. This is the EGM MT4 platform, and we are on live markets. We are live on the markets. The markets are moving, and I'm going to be analyzing this live with you to just make sure that you grasp all the concepts and you understand the topic of today's webinar and how significant this topic is. I discussed about price action signals and how we tell, when the sentiment is changing. Open on our chart right there is a price channel. We discussed about price channels and breakouts in our first webinar that we conducted. That is the first webinar we conducted. That was on the topic of breakouts, and we covered channels at length. And as I was screening the markets earlier, I just came across a very interesting candlestick pattern that I have highlighted using the eclipse here. And this is the candlestick reversal candlestick pattern, more of what we refer to as a pin bar. And a pin bar simply informs us of a change in sentiment of the markets. But then again, the formation of the pin bar, even understanding that a pin bar forms when the sentiment or the direction of the market is changing, especially when it forms at the boundary of a channel, like we have the upper boundary that is indicated by the upper line, then this gives us an hint that the sentiment of the market is about to change. The sellers are about to take over the market. But then the formation of this pin bar is not a confirmation to take the trade or to jump into the markets. And therefore, I'm going to highlight the confirmation. If you're trading such a channel and you're on the upper boundary or even at the lower boundary and such a price action candlestick happens, a pin bar, then you always have to wait. This is a daily time frame, and every candlestick here represents a full day of trading. And therefore, if I was in the market, if you are in the market, you would have needed to wait for confirmation, because the pin bars formed telling us or informing us the sentiment is about to change, but that hasn't been confirmed. And this is all about, we're talking about today, about trade entry confirmation. And I'm just going to draw and show you the confirmation candlestick that should have informed you to open or take a trade, or just take the trigger and comfortably and confidently take your trade. So this is our confirmation candle, and it's a bearish candle. And therefore, this is our confirmation candlestick that happened after the reversal pin bar candlestick formed. And therefore, having said that, then it makes total sense to put to have at the close of our candlestick would be our entry point into this trade. That is, if we wanted to open a trade based on this pin bar and based on this channel, after this pin bar occurred, I would have waited for this bearish candlestick that formed after the pin bar, which is a clear confirmation that actually, even after the pin bar was formed, the bears actually took over the market. And this is shown to us by the bearish candlestick that happened, confirming that the sentiment has actually changed. The direction of the market has actually changed. And therefore, the price of 1361 on this pair of the Euro USD would be my entry price level. This would be our entry price level. And then, of course, we would look for a proper risk to reward ratio and target our take profit at the price of 12.24. And then, of course, have our stop loss just at the open of our confirmation candlestick. This would give us a classic risk to reward ratio of 1 to 2. And these are some of the things that you should have in your trading plan. And these are the things that should inform you when you are about to take a trade. What is the trend of the market? In this case, we're trading a channel. So you see the prices are at the upper boundary of the channel. We don't normally trade channel mostly at the boundaries of the upper boundary and the lower boundary. And if we see price action signals that the pin bar that happened here forming at the boundary, then that is our time to get ready to enter into the market. And especially after confirmation such as happened here formed. And you see, if we were in the market and you took this trade, it could have turned out to be a rewarding trade. You don't need very many wins to actually make money in the forex markets. You get such trades, one or two or three. Even you have, three winners and one or two losers in a month with proper risk to reward ratio, meaning what you're risking is in the market is way below what you look forward to earn. Then you're good. You don't need to open positions every now and then, every day or every 4 hours. You screen in the charts, trying to force situations or the forex charts. And therefore, this is one of the examples. And I'm just going to screen through another example. This is the pair of euro Australian dollar. But even before I move to the next example, I want to call in George, to tell a point or two, add on to the confirmation based on the price action signal of the pin bar and the bearish confirmation that we've discussed, or any other ideas you might have regarding the same. So I just call in George to join us.
I'd like to talk on the setup right there. Can you see the main trend? If you just follow the 3 steps that you just told you, can you notice the main trend? Can you notice a chart pattern? Can you see the head, shoulder pattern? And this was confirmed by a certain pin bar on the right shoulder. I'd also like to notice a certain pin bar that formed against the main trend. And this is what you're talking about following the main trend, because you can see there's a head, shoulder pattern. If Josh can highlight it for me, the head, shoulder pattern. And yeah, the head, shoulder pattern. You can see there was a pin bar forming right on the right shoulder. Yeah, and this is what to tell you the beauty of studying chart patterns. Can you notice these chart patterns? Can you follow the main trend? Okay, and this is the advantage of using the 3 paradigms I've told you. Can you notice the trend? Can you tell the chart patterns? follow the main trend. Now, after you notice the chart patterns, look for the candlestick formations that actually form in those chart patterns, and these will guide you on making very high probability setups that offer you low risk and high reward, because money management is all about low risk, high reward.
Thank you, George, for that. Thank you for that. I wasn't quite ready to analyze the pair some more for the head, shoulder, shoulder, but you know, if you are a price action trader and you frequent on the markets, then you develop a quick eye to analyze the charts and tell different chart patterns. We call them confluences. For instance, on this pair, as George was discussing, we have a channel which is combining with a head, shoulder, shoulder, but that is more of a whole topic that you would have to cover again. But then that is a point on a topic that we call confluence. That is when multiple price action patterns are converging at one point, and this is usually quite a big deal, as in an edge to approach the market and open positions with a confidence. The next chart pattern that is showing on our currencies, that is the euro, Australian dollar, is a triangle and a breakout. You remember the first topic on our first webinar, we discussed about a breakout. And you see, at this point that I'm going to just illustrate, this was our breakout point. This bearish candlestick was our breakout. I'm just going to indicate this using some text. This is our bearish breakout candle. But then after this bearish breakout candle formed at this point, this wasn't enough, proof or confirmation for us to enter into a sell position based on this breakout on this triangle. But then the second candlestick, the second bearish candlestick that I'm indicating right on the chart, this would have acted or should have acted as our confirmation signal. So this is our confirmation candle to go long. This would be our confirmation candlestick in order to open, to go short, sorry, not to go long. This would be our confirmation candlestick to go short on this pair, or to open a sell position based on this bearish breakout. And therefore, this is what we mean by waiting for confirmations to happen. Therefore, the close of this bearish confirmation candlestick, which is at the price of 88.27, would be our entry price level in taking up this trade. And therefore, at this point, we are confident that a breakout out of the triangle is formed, and we've actually confirmed this by the second bearish candlestick that confirms the sentiment of this trading pair that sellers have taken over the market. We have a bearish candlestick, and now it's time to go short. With all the confidence, we can now bring in our money management plan, schedule our stop loss level, which would be the ideal place to place our stop loss level would be just at the open of the breakout candle that is up here. And then of course our take profit would target like a risk reward ratio of 1:2 or 1:3, and scheduling our take profit at this level would be ideal, and this would have given us a very classic scenario of a risk to reward ratio of at least 1:2. And this is what we mean by waiting for confirmation signals or candles to happen on the charts on the various markets. Just screening ahead, I want to look for another example. This is another example of a price channel that we just highlighted using some eclipse of the turning points. And what we find is that when you're trading price channel, we usually look for the behavior of the market at the boundaries. At the boundaries, that is the upper boundary and the lower boundary. I'm just going to indicate this. This is the upper boundary. This is the upper boundary. Right there. And then, of course, this is the lower boundary. This is the lower boundary. And therefore, we look for how the price is, the behavior of candlestick patterns at the swing lows of this price channel at the upper boundary, at the lower boundary, and the swing highs of the upper boundary. And you see the behavior of the candlesticks around the areas that I have highlighted using the eclipse. What is happening is, for instance, if we take, for instance, let me just indicate one example and put this as example 1 or example A. Using our example A at this eclipse, we find that there is a bullish candlestick that happened, that I'm pointing the cursor at, that happened, showing the rejection, or that the sentiment of the market is about to change. But you realize that this candlestick was not really a reversal candlestick, as in examples of reversal candlesticks we look for in the price action. But then it happened within the boundary, the lower boundary of the price channel. And what followed after that is another even stronger bullish candlestick that I'm just going to highlight. And this would have acted as our confirmation candlestick, to open a buy position based on this price channel, because the sentiment is changing. The markets are respecting, the swing lows and the swing high of the price channel. And the formation of the second bullish candlestick after this candlestick rejected the downward momentum of the market, this would have acted, of course, as our confirmation candle. And therefore, this would have acted as our confirmation signal or candle. And at this point, it is at the close of this candlestick that would have been our entry point, or the confident level for us to open a position based on this confirmation, based on this price channel. And therefore, this could have been our entry point. And of course, we target a nice risk-reward ratio of at least 1 to 2. And we could have positioned our stop loss just at the open of the rejection candlestick or the bullish candlestick down here. And then, of course, our take profit up here at the price of 29.82. And these are some of the examples of how you look for confirmation candlesticks in line with what we discussed earlier on our slideshow presentation. And therefore, there are many examples we can find on the charts. And therefore, this is another example of a breakout that happened on a wedge. You remember we covered the wedge in our first webinar when we were discussing about breakouts. And this is a classic example of, just going to zoom out, of a webinar that occurred at this point. I just want to show you. So this was the breakout bearish candlestick that I'm pointing the cursor at. And then, of course, you see now the reason why we always inform or advise you to wait for a confirmation candlestick. Imagine if you entered a position at the close of the breakout candle, and you see what followed in the following 2 weeks, because this is a weekly time frame. Okay, what followed in the following 2 weeks were 2 bullish candlesticks that happened to be inside bars. 2 bullish candlesticks, 2 full weeks of your trade being in the loss zone, just because you did not wait for a confirmation candlestick. And what followed after the 2 weeks is a bearish confirmation candlestick right here. This should have acted as your confirmation candlestick to open a position based on this breakout. So this is a confirmation trigger or confirmation signal to open a position. And therefore, With that, our entry point could have been at this point, and then of course our stop loss could have been just at the open of the breakout candle up here, and then of course we'd position our take profit to a ratio of at least 1 to 2 and position it right at the price of 138.89. And these are all examples of scenarios in the live market of how you're supposed to wait for confirmation signals before you get to open a trade position. And at this point, I want to hand it over to George, to add a point or two. And then after that, he's going to read out a question or two so that we can address a few questions that, in case there is any, that our audience have, forwarded to us as we get to the close of winding up on our today's webinar. George, kindly.
Yes. Yes. Thank you so much. Thank you so much, guys. First of all, for tuning in. We are about to end our webinar, and we have shared a lot of wisdom with you guys, a lot of our experience, our losses, and if you just follow what we tell you, that's enough for you to be a profitable trader in the long run. Okay. You may notice how the pound yen trade worked out. You had to wait for a couple of weeks. I don't see if Josh can demonstrate like the amount of discipline that is required in this industry, and that is 90% of this business. Discipline. You got to be very disciplined, because once you get the confirmation, the trade may not just work immediately in your way. You have to keep your mindset straight. One thing we always tell you: do not move your levels. If you analyze the market and you identified certain stop loss levels or take profit levels, and you saw that the trade is not going against you, start adjusting your stop losses. It's very risky. Okay, never do that. It can cost you a lot of money. And I don't really have a lot to add into what Josh has said. He has covered almost everything that you need to know about this industry. And with that, I think I'm gonna cover some of the questions that were answered. And guys, please engage us. We are giving this information to you for absolutely free. This is a lot of wisdom, and this information is not easily available for free. Okay, so please engage us so that we can actually share with you wisdom and you can be profitable traders with less time. We don't want you to lose your money. And one of the questions that has been asked was on which time frame do I wait for the confirmation? And if you go through our course or through our webinar, we talked about a strategy called the top-down approach, and we always analyze the market from the higher time frames down to the lower time frames. And we always emphasize, as you can see, you have demonstrated these demonstrations on weekly and daily time frames. Wait for the confirmation on the same time frames. You're going to get less signals, but once you get a signal, it's gonna be a high quality signal. That's the point. You rather not trade or not risk and come out with a loss. You rather have to wait and preserve your capital and wait for an opportunity to present itself, and it's always going to present itself. You just have to have the patience and the discipline and the skill, and really emphasize on the skill to notice these things and act on them. Okay, one thing I should tell you is that never look at the market and see what the market should do. Look at what the market is doing, and that's the beauty of price action. And that's why I don't advise people to trade using indicators, because indicators, they cloud your judgment on what you should do or what the market should behave. Okay, and the beauty of price action is, one, you'll get better high probability setups. You're going to get less risk. You're going to identify trends early, before even an indicator person or a fundamental guy identifies that the market is moving. And this awards us with a risk, low risk, high reward ratio. Okay, so confirmations. If you're doing your analysis on the daily time frame, wait for daily confirmation, wait for the daily close. If you're analyzing the market using the weekly time frame, wait for the weekly close. If you have the muscle to analyze the market using the monthly time frame, wait for the monthly closes. And these setups will always present themselves. Do not rush the market, or the market will rush you home.
Do not rush the markets, or the markets will rush you home. Those are not my words. Those are George's words, but I must agree with those words. If you rush the markets will rush you home. It can be very costly to try and convince the markets that you're right. This would be the most expensive lesson you'll ever learn in Forex. And so I don't think I can even add any more to what George has, covered regarding that question right there. But the point and the beauty of price action is that it doesn't matter which pair you analyze the Forex markets. As long as you master price action, these patterns, price action and Forex trading is based on the principle that history repeats itself. These formations, such as wedges, such as triangles, such as the price channel that is showing on our screen, will always repeat themselves day after day, week after week, month after month, year after year. If we screen back and we do a back test of the different pairs that are open on our charts, we'll find that these shapes have happened over and over and over again. And the job as a price action trader is to master these patterns, be able to decipher when the confirmation is happening and just pull your trigger. Make sure you are trading alongside the main trend. And of course, as long as you follow the rules, your money management is sound and into place, then no doubt you will make money consistently from the Forex market. You try to go against these rules, you try to rush the market, again, as George put it, the market will rush you home. And I think, I don't know whether we have any other question, George. Let's have one or two questions, then we respond to them, then we can wind up on our today's webinar.
I have a question by Patrick Wanyoike. He's saying, how do you deal with losing days?
Wow, that's a good question. I think Wanyoike has got some experience in the markets. How do you handle losses? How do you deal with losing days? Now, I want just to take half a minute to respond to this question. Before even you get to the losing, because everybody experiences losing trades in the market. I experience losing trades, 11 years later into the Forex market. George has had losing streaks. You go to any trader out there in the world, the best, Forex again is a business. And therefore, our aim is not to eliminate losses. Our aim is to manage losses. And therefore, if your money management plan and your general trading plan is solid, and that this trading plan has made you money before, and you trust in the process, you trust in the price action, you trust in the confirmation entries that you're looking for before you enter the trade, then even if you experience a streak of 1 or 2 or 3 continuous losses, even in a month, then the fact that you trust in the process and your money management plan and your trading plan is solid, and you're sure without a single doubt that you entered your trade based on a confirmation signal, you did not rush, you did not overtrade, you did not risk too much of your capital, then losing is part of the business. Actually, the losses we encounter in Forex is our cost of doing business. Like when you start a restaurant, I think Some of the losses you have is whereby you haven't, sold all your food and you have some waste at the end of the day. And you have all these kind of losses, or you start another business, or you are in the in the transport industry and it's a bad week, you know, and you haven't done as many trips, and at the close of the week you count your losses. But that does not mean, you just sleep home and don't show up at work. It's part of the business. So our losses as forex traders are part of our business. We never avoid losses, and this is why we say never move your stop loss. Take up the loss.